Hey folks, welcome to another conversation on Business Redefined, your weekly most comprehensive look at the world of business, finance, and economics. 3 years ago, we had the debut conversation on the public service superannuation scheme. I think the first conversation in this market, and we want to walk back and now see the status update. As at now, we are privileged to have the man in charge, Dr. Jonah Aiyabei. Karibu sana, Daktari.
Thank you very much.
He's the Chief Executive Officer. I missed to say that. Karibu sana again.
Thank you. Thank you. You said your name is Julie?
Yes, Julius is my name.
Julie.
Yes. So we have had 3 years ever since we rolled out the public service superannuation scheme. And maybe let's just start with an update. Where are you in terms of uptake, the assets under management, and what progress has been made so far?
Thank you very much. I'm glad that this is not the baseline interview. You had one, you said 3 years ago in 2021.
Yes.
And that really marked the beginning of this scheme. It began in January 2021. And 3 years down the line, that's where we are now in 2024, we have made some strides. We have made some progress in terms of operationalizing this great fund in our country. So the scheme began in January 2021 by transitioning members who are in the old scheme to start contributing for their future retirement benefits to this new scheme. Those who are 45 years and below were required to automatically join this scheme. And then they were given the option. For those who are above 45, were given an option to make a decision whether they would want to join, but it was mandatory for those who are 45 and above. So, of course, the uptake was a little bit easy because it was a directive. If you are working within the environment that was being captured by this scheme, say then the government, the mainstream civil service, the Teacher Service Commission, the teachers who are the teachers of Teacher Service Commission, or the National Police Service, Kenya Prisons, or NYS, automatically you could join this scheme. You are actually required to join if you are 45 and below. So 3 years down the line, we have seen the numbers of the scheme growing very, very fast. Now we are talking of having a membership of 443,000 cutting across. Those are the membership. And these are largely, the biggest population are coming from our teachers' fraternity. And then we also have from the National Police Service, which is around 116,000. We are talking about those who are in proper civil service, SACAs and all the government ministries, around 65,000. And therefore, we are looking at a big team that is touching everybody within the jurisdiction of this country.
Wonderful. That's quite a sizable number of members.
Yes.
But what about your assets under management?
Well, that one has been growing. You know, as the numbers are growing of members, also the contribution is growing because it's a function of the salaries of these employees. So we have now assets under management at the tune of 157 billion, which has grown over time. From zero start in 2021, no assets, to now we have assets that are actually supposed to meet the benefits requirements of these 443,000 members, which stands at the tune of 157 billion as of 30th September 2024.
Okay.
So that has also grown. I mean, a scheme of 3 years old having such a big size of assets is really not a mean achievement. And that has put us now at the level where we are the second biggest pension fund in Kenya after NSSF.
Yeah. And so maybe let's walk back a little bit, just for context for those who might not know. So why was it of essence to migrate people from the defined benefit scheme to the defined contributory?
Yeah, it is it is a practice all over the world. The best governance practice of running a pension scheme is that pension schemes should be funded. So the previous arrangement, there was no funding. There were no assets that you could say these are the assets owned by government that they will use to pay their retirees when they exit. But this one now that we have a fund where employees contribute fund money, a percentage of their basic salary, and the government puts it, and therefore we put in a fund and invest for their retirement. That in itself gives some sense of guarantee. It gives some sense of stability in terms of knowing that when my time of exit comes, you have guaranteed funds, or rather the funds that has been set aside. Now, in the other arrangement, you know, the government was just making provisions in the annual budgets to say how many pensioners are we likely to pay next year. Then they set aside a budget. If there are some fiscal challenges within government, for example, it leads to some bit of delay.
Yeah.
But this new arrangement is the assets are segregated from the sponsor. They are different. I mean, the sponsor and the employee have not access to these funds. So they contribute, but it has a non-reverse system where you cannot give it back to government. So it creates some sense of stability. It gives some context to the employees that they'll be able to get their funds when they retire. So that was very critical. And if we look at all over the world, the fundamental pension support is where it is funded. The unfunded schemes are not sustainable. They create issues at the time of claim. It creates delay and a lot of noise and complaint by the beneficiaries. But this one, the money is actually vested on you the day you contribute.
I see.
Yes.
And when you talk about the 157 billion, how is it split across various asset classes?
Well, we run as a scheme a very robust investment policy. So we have developed an investment policy statement that has been approved both by our Board of Trustees and also registered with our regulator, the Retirement Benefits Authority. So within the investment policy statement, we have categorized the strategic allocations upon which these assets are put. We allow some investment in government securities. We have put part of it in quarterly equity, and quarterly equity. We are also thinking of diversifying to private equity funds. And we are also coming systematically to property investment. So at the moment, we are largely on the government securities for obvious reasons, because we are still stabilizing the fund and also building the system so that before we go to other areas of investment, such as properties or private equity, we need a time to really put in the right human resource, get the right advisory, get the right consultants, so that we can actually access that particular area. But for the beginning, you will look at it that over almost over 92% around 89% of the assets now are in government securities, both the T-bills and long-dated government bonds.
I see.
Yes.
And without mentioning the name, we have had challenges in this industry where there are deductions but delayed remittances to schemes. Mm-hmm. Is it something you've encountered?
I think we have been fairly, let me say, lucky, or the foundation of this scheme has been solid. And therefore, such delays that we read in the media or in the industry where some institutions are deducting and are unable to remit, we have not seen that problem. Now, what we have done is that it's very clear among the sponsors and the employers on the obligation. And let me put it this way, the way even the governance structure has been set is that for every employer, we have a representative in the name of a trustee. And we have put it very clearly that as you pay salary, the same time you remit a portion of the employee. And that has worked fairly well. Now, the sponsor, on the other hand, has been very, very good to this scheme. I guess, courtesy of the challenges that I've been having in the unfunded scheme, they are committed, and we have not seen a challenge in terms of them making their contribution of the sponsor's portion of the employees.
I see. There have been developments in the regulatory landscape to change the industry and practice. What does this mean for you as an entity?
Well, the developments in the retirement benefits industry are welcome in many aspects. If you look at what happened, let's say 20 years ago, or the regulations of RBA came into being in the year 2000. We are now talking about around 24 years. The Act was established in 1997. So over 25 years, we have been operating within some structural regulatory environment. But the changes that have been proposed, the changes that have been innovated even by the regulator and the practitioners in this space are actually a welcome move to enable improving the portfolio of the scheme. Now, if you look at some 10, 15 years ago, we didn't have clarity on how to regulate things like REITs, for example, how to put investments in some private equity. But now where we are, pension funds are able to participate, not directly in investment, but through vehicles like REITs. There are now funds which are well structured that can be invested, and it opens up. There are even some new instruments like infrastructure bonds that at least pension schemes can put in. If you look at around 25 or 20 years ago, the space for investments was purely limited to quoted equity, some bit of offshore investments, which it was not very easy to monitor, and again, of course, the government securities. But the changes has been a welcome move, but not to mention that there's still room to also do some bit of transformation.
Okay. One of the landmark developments in the recent past has been the publication of the National Retirement Benefits Policy. How does that impact the industry in your view, and also specifically the superannuation scheme?
Very, very, very critical. The policy is a well thought out document, and one of the key things that it emphasizes is coverage. You realize that if you talk about the coverage of those who are in the pension space are so low compared to the larger population. So within that policy, it's looking at ways upon which it brings people on board to be also partakers of pension arrangement that is structured, that they can be able to receive the funds when it falls due. So that arrangement of the national policy is encouraging institutions to have the schemes funded, and that's a very critical thing. And if you look at now where we are within the superannuation scheme, we are running a funded scheme. Therefore, we are setting aside assets, and you're able to pay at the time that when they fall due. And they're also putting in very clear structures of all these investments, and monitoring can be done. So it's a well thought out document that has actually supported the operationalization of pension schemes and the wider coverage.
And speaking about widening the coverage, if we look at official data from the market regulator, it indicates to us that out of every 10 persons working in this country,
Yes.
just about 2 have what they would call a formal pension scheme. And the question is, how do you cascade pension solutions to the wider market, especially those in the informal economy?
Yeah, my thought is these umbrella schemes, wider education of employers, because much of this development of pension funds are driven by the employers. So if within this policy, and you look at the way they are saying if you are an employer, the way they drive the NSSF, for every employee it's mandatory that you must contribute to the NSSF. So those policies that drives every employer to make sure that they make aside or they create a pension for the employees will really increase the level of coverage. But the most important thing is not just about coverage. The key thing is what is the value of income replacement that this person that they work after until their retirement, will it be something reasonable that it can compensate? So we should also come up with policies to say that other than just creating a pension for them, the quantum and advice from qualified people to tell you this pension will surely give your employee a decent retirement package should be analyzed and be put across the board. So I'm looking at a place where beyond just employers coming up with pension scheme, we should have a think tank guiding on what contributions should be made so that at least it can give a decent retirement replacement income when people exit formal employment.
Doc, it's been about a year since you took over the
Yes.
leadership of this institution.
This is my 12th month, yes. It's a year now.
How has it been so far, and what have been the milestones?
Oh, I can't believe it's a year. The first thing is, one, I took over when it's in November last year, and there have been a lot of changes. One, within a month, the Board of Trustees term came to an end, and I had around five or so months without a board, but at least things have worked on very well. We came in straight away to talk about digitization, and we brought on board a very robust ERP so that it can be able to support our management of the scheme. We have also done a strategic plan. I found it was on course, but we first and foremost moved at speed to make sure that we complete the strategic plan and launch it, and which we did it in June this year. We also undertook to build capacity among the human resource. Many of the staff members had been deployed from various sectors, and we wanted them to have a clear thinking and skills or skilling and putting the vision of what a pension scheme. So we did a program of really building capacity among the members of staff that are joined. And within the year again is to scout for areas of diversification. So in this first year, we have already identified some areas that we believe can actually enrich our portfolio for better returns. And many, many other things. We didn't even have an office space. Let me put it this way. We have settled in this office, I think this is our 3rd month. So we had to look for a place to even call home temporarily to be able to manage and have a place to be able to serve our members. We are also going forward looking at other avenues of improving on ICT systems that are ongoing at the moment, and also building a robust website, developing a way where members can reach us online from the point of where they are. Yeah.
Doc, I'm very curious about what you've said about the strategic plan
Yes.
and looking for avenues to unlock higher return. Which are some of these pockets you're looking at to deploy this investment to unlock higher return?
I think one of the key things that we have decided to do together with the Board of Trustees is to just go beyond the traditional ways of, it's very interesting to say that when you do the investment, you look at two things, the risk and the level of return.
Yeah.
And even in business schools, that is the topical thing that finance people are being taught, look at the level of risk you are taking and the return. But we want to go beyond the two R's and bring in an I, that is the impactful investment. How does this investment that you're making impacting the society? So we are looking at double R plus I. That is to say, we will be careful to select the investment that will give us a decent return of at least, of course, we're looking at least 12% on our funding, and again, not exposing the risk so high. But beyond that, how does it impact the current person at the moment? So in the area that we're thinking about property investment, if we are to go to housing, for example, we will be very careful in looking at those funds that are ESG compliant, those which are environmentally responsive, socially responsive, and the governance are good. So that is why we have developed a very robust ESG policy that will support our investment as a scheme. This is not a very common thing at the moment among the pension schemes, but we are really trying to say yes beyond the R in terms of risk, beyond the return. How is it impacting in terms of environment, in terms of the society, and also the governance? So we are very careful on where the investments will be going, will be putting on going forward.
Okay.
Yeah.
At the start of this conversation, you mentioned that currently under your assets under management, about 80% is in government securities.
Yes, around 80% government.
Where would you like to moderate this to as you focus on other opportunities?
Wow, it takes long. To rebalance a portfolio is not a month thing, it's not 3 months, it takes long because we have to be very, very careful in restructuring. But we are looking at in a year's time or in around 1 year or so, we should have brought that exposure in government securities to close to 50% of our portfolio. We'll have brought in very decent PE funds that can actually address this. We go to unquoted areas of equities and also look at other opportunities, including offshore investments that we believe can make it a decent rearrangement. So I can say for now, we are still constructing our portfolio.
Okay.
Yeah.
Which is a good place to be at. As we dial down our conversation, what is your, and you did touch on this already with your strategic plan, but where would you like this fund to be as you look ahead?
I would love it to see it as a trillion value fund in a very soon future. We are talking about now 160 billion. I mean, by the end of this year, it will be about on 170. So we are looking at it within between 5 to 10 years, we should be talking of that big number. A very solid fund that can actually make impact to humanity, both in Kenya and pay a decent return to the public servants.
I see. And I'm curious, how do your payouts look like?
At the moment, I mean, as I told you, we took people who are 45 years and below. So exits are very low, given that they still have a headroom of 12 years to reach the normal retirement. But for those who are actually exiting for other obvious reasons, say because of the police service, they have reached their retirement, we have actually been paying them. We don't delay their payment at all. Yeah. But the exits at the moment, and this will be expected for the next 12 years, will not be massive. So we are using these 12 years to really reform our portfolio, put our investments in order, and make sure we build a solid return for the people when we'll have a bigger exit in 12-year time to be able to pay them.
Okay.
Yeah.
Doc, as we close, this industry, especially the pensions industry, has had a very interesting episode.
Correct.
Because in the recent past, especially 2023 and 24,
Yes.
what we have seen in the market is very elevated yields. And this, of course, has an impact on the valuation of your holdings.
Correct.
Mark to market.
Mark to market.
Has this been a point of concern for you?
Of course, it has been, because the inverse relationship of when the interest rates are doing very well and the issue
price
of pricing of those bonds and valuation, it has been a concern. But really, strictly looking, we are not. It's a book change. Let me put it that way.
Yeah.
It's not having a direct impact. It's actually a movement of the value on paper, but ultimately, so long as we are not exceeding the employment, we cannot say you have crystallized that paper loss. So, and again, you know what RBA did. The regulations were changed last year that you can hold some assets and you don't need to mark to market so long as you're not trading on it. It's, of course, a very interesting move. But with or without that regulations, so long as you're holding these assets and you are looking at holding them to a reasonable time, to me, I think markets have to move. And that's why we have fund managers. That's why we have technical team with our scheme to be able to monitor. And that's why we bring in on diversification to really see how when one is going down, another one is not suffering. Yeah.
Okay, I see. That was legal notice number 18 you're making reference to from the RBA. It was a fantastic and interesting discussion we had.
Yeah.
So, Doc, what's your parting shot? When you look at the scheme and the public, what would you like the public to take away from this?
Okay. I think I will say that we have a pension fund. We have a solid structured pension scheme that will live true to our promise to pay the members accurately what they are supposed to be paid, pay them on time, and at the same time invest their money in a prudent manner that will really give them what the greatest value that it could be expected within the environment. So we are here to serve them. We are here to make sure that we take care under the fiduciary arrangement, the assets that have been bestowed to our trustees, and by extension to ourselves at the management of the scheme.
All right. We have been having a conversation with Dr. Jonah Aiyabei, the Chief Executive Officer of the Public Service Superannuation Scheme, taking stock of the last 3 years and more fundamentally for him, the last 1 year ever since he took stewardship of the scheme. Currently at about 157 billion of assets under management, and the target is to scale it up as much as possible. So we shall be keeping tabs on this development to see where this fund actually goes. Stay tuned.